Hi folks, Doug Wilson with Wilson Kia, Wilson Hyundai on Lakeland Drive in Jackson, Mississippi. As a service to the public, I wanted to come on this short video and just try to talk about little tips of things that might help you. Today we're going to talk about FICO scores. What in the world is a FICO score? Well, FICO stands for Fair Isaac Company. It's a company out of California that developed a predictive model, a statistical model, to determine repayment probability. And they sell that product to all kind of financial institutions and banks and so forth, and it's widely used in the mortgage and car loan and consumer loan of all type to determine the probability that the bank will get their money back. Which, after all, when they lend you money, that's all they want. They want their money back with interest, right? Well, some of the things that go into your FICO score is length of time in your residence, how long you've lived where you live, whether you own or rent your home, what you do for a living, your occupation, how long you've been there. One of the things is whether or not you have department store or major credit cards. That's a plus, by the way, if you have department store or major credit card. If you have a bank reference, by that we mean do you have checking and savings account. If you don't have a checking and savings account, it's a real easy way to improve your FICO scores to get a checking and savings account. Doesn't really matter how much money you have in it, but that you do have a checking and savings account. Another is your debt ratios. Let's say that you have mortgage payment, car loans, and credit card debt that is $1,000 a month, and you make $4,000 a month. Well, then your debt ratio would be 25%, because 1,000 divided by 4,000 is 25%. So your debt ratio is a big portion of your FICO score. Another thing is how many inquiries. Lots of inquiries mean maybe there's some trouble or something, and the model will score you poorly for having lots of inquiries. Another is how many years have you been in the file. In other words, how many years have you been in the credit bureau. So the longer you've been in the credit bureau and the more repayment history they see, the higher your score is likely to be. Another is the number of revolving trades that you have is a factor that goes into impacting your FICO score. Another is your percentages of the balances that you have available. So in other words, if you have a credit card and you owe $10,000 on your credit card, you have a $10,000 credit card limit, you have zero of balance available. But if you owe $10,000 on your credit card and you have a $20,000 credit card credit line, then you have 50% available. So a percentage of your balances that are available for additional credit. That's a positive in a FICO scoring situation. Obviously, a negative would be any derogatory credit. Any derogatory credit such as liens, judgments, repossession, obviously bankruptcy, any payments that are made over 30 days past due, over 60 days past due, over 90 days past due, and that type of thing. So now we've talked a little bit about what a FICO score is and some of the factors that determine your FICO score. Why should you care? Well, obviously, the higher the FICO score, the better interest rate you're going to get on a home mortgage, on a car loan, or pretty much any type of consumer loan. And also, even in this day and age, insurance companies pull your FICO scores to determine what they charge you for insurance. Even employers such as ourselves, Wilson Auto Group, we pull credit bureau on prospective employees, as do many companies now, to do pre-employment screening. So what is a good FICO score? What's a bad? Well, FICO scores range anywhere from 300, which would be very, very low, to 850. And 723 is the median. 678 is the average. And anything under 620 is considered subprime, which would probably be a higher interest rate and a whole new set of rules and regulations, different lenders even, that would only deal with someone that had under a 620 FICO score. I suggest you get a free credit report annually and pay extra to get your FICO score and get the true FICO score, not the Experian or one of the other credit bureaus kind of knockoff score that's similar to that they charge you for. There's also been a recent Fitch study that says that FICO scores are not as accurate a predictor of payment probability as they used to be. And therefore, a lot of lenders are looking at deal structure. And what we mean by deal structure in this day and age is down payment. Obviously, the more down payment, it puts the lender in a better situation relative to the collateral. If you put half down on an automobile and the automobile had to be repossessed, then they could probably sell the automobile and recapture the amount of their loan. If you had a trade you were upside down in, you put nothing down, and you finance over the list price of the car and the car are repossessed, obviously they'd be in a much worse position. So that's what we mean by that. Deal structure, down payment, cash or trade-in. Also, your car payment. Well, how much of your car payment, what would your car payment, prospective car payment be relative to your overall income? And it also, it matters whether or not you trade your car in. So if you're trading your car in and you owe $350 a month on your present car and your new car payment would be $450 a month, well then you'd only need to have the financial margin to justify the $100 increment rather than the entire $450. If you didn't trade the car in looking at the deal structure and not being certain whether or not the car was going to be traded in or not, you'd need to have the financial wherewithal to support the whole additional $450 car payment. So those are kind of some things that the lenders look at, and everything, monthly payment to income, your total debt to income, trade-in, down payment, the value of the vehicle, loan to value. So, practically though, what can you do about it? Well, I hope this video has been helpful to you and give you some practical tips. One, like we talked about, trade in your vehicle, because we think that's important to get rid of that old debt, and it also frees up that amount for your payment. Another thing you can do is to increase your available credit on your credit card. You can do this by one of two ways. Obviously, you can pay your credit cards down so that you have more available balance, or you could ask for an increase in your credit line without using it, which would make you have a higher percentage of credit available on your credit line. Another thing that you can do is buy a car before you change jobs or before you move, because like we said, length of time in residence and length of time on the job are factors that impact your FICO score. Pay your bills on time. That's an obvious one, right? But another one is to put more cash down. That'll help you get a better interest rate on a car or a home mortgage. So that's what we want to talk to you a little bit about today, probably more than you wanted to know about FICO scores and what it means and all that type of thing and how it's impacted. Well, I hope this has been helpful to you. I'd appreciate if you'd leave some comments. And if I can help you with anything, you can leave me a private email message at Doug, D-O-U-G, at wilsonautos.com. Thank you.